across the euro area. And what do I mean by that? Okay, we're good to go. What do I mean by that is that whenever the European Central Bank, the ECB, moves interest rates, well, then you're going to have some countries responding much more strongly than some others. Say in aggregate consumption, for example. And this example is Spain responding much more strongly than Germany, for example. So, and this is what I mean by monetary policy as heterogeneous effects. Now, what do I do in this paper is I'm going to link these heterogeneous effects of monetary policy to structural features of the housing and mortgage markets across euro area countries. In particular, I'm going to be focusing on adjustable rate mortgage shares and home ownership rates. And now these are features which are extremely different across European countries. And since this is a mostly US crowd, I'm going to be showing you some. What I mean by that is that if we look at adjustable rate mortgage shares in the euro area across euro area countries, then we see striking differences. Okay, so we have starting from Austria all the way to Slovakia, you see a lot of heterogeneity with some countries like Spain, which is ES in this chart, having it all about adjustable rate mortgage shares, while some other countries, say Germany, which is DE, which is mostly fixed rates mortgages. So huge heterogeneity, and this is the same if we look at actually home ownership rates. Home ownership rates with some countries, again, like Germany, being, having home ownership rates of around 40%, while some other countries like Spain, again, going all the way up to 80%. So again, big differences across countries, and the idea of the paper is actually to link these differences with the heterogeneous effects of monetary policy. Now, there's going to be two big sections in the paper. The first one is going to be about empirics, where I show strong correlations between the local impact of monetary policy, so how strong or effective is monetary policy across countries, with the structural features of the housing and mortgage markets, namely adjustable rate mortgage shares and home ownership rates. I'm going to then moving on to a new Keynesian model of a currency union, where I'm going to be very careful in modeling long-term mortgages and home ownership rates. Now, the model is going to be useful to quantify the separate contribution of adjustable rate mortgage shares and home ownership rates to consumption. And then, the model is going to be useful to ask policy-relevant questions. One of the questions that I'm going to be discussing today is, what are the effects on the monetary transmission mechanism of a unified mortgage market? Mortgage markets are also very different across European countries. So I ask, what will be the effects on the monetary transmission if we have a unified mortgage market, one that works more similarly across countries? And then I'm going to be asking, what are the consequences of introducing house prices into the euro area price index? Okay, so let me just give you, since this is going to be a relatively short presentation, just give you a preview of findings. So in the paper, I show the countries that have the stronger empirical responses to monetary policy in terms of, say, aggregate consumption, price to rent ratios, mortgage issuance, and mortgage interest rates, are actually those same countries that have high share of adjustable rate mortgage shares and high home ownership rates. However, I'm going to be showing you today that adjustable rate mortgage shares and home ownership rates across countries are actually correlated. So it's hard empirically to say, the strong empirical responses that we see to monetary policy, whether they come from countries having high adjustable rate mortgage shares or countries having high home ownership rates, because those are essentially the same countries. And this is why I turn to a structural model, a quantitative new Keynesian model, where I'm going to be focusing on very closely to the housing and mortgage market. It's going to be a currency union model. So in the model, I'm going to have two countries and think of them as Spain and the euro area. So that's what I'm currently calibrating the model to. And in particular, I'm going to be, very careful in calibrating the model to these striking differences that I showed you before in terms of, adjustable rate mortgage shares and home ownership rates, but also home ownership rates, the fraction of people with mortgages versus without mortgages, outright homeowners. In particular, the model shows that the consumption responses in Spain are about 2.54 times as strong as the responses in the euro area. So this is pretty close to the data counterpart. And so Spain responds more strongly than the euro area in terms of consumption from the data and also in the model. And then I'm going to be using the model to sort of show the relative role of adjustable remortgage shares and home ownership rates. And in particular, I show in the paper that these two features, adjustable remortgage shares and home ownership rates, actually interact to amplify the effect of monetary policy. And so the two separate channels are, the fact that Spain has a higher adjustable remortgage share. So what that means is that obviously, not surprisingly, there's going to be a stronger pass-through from the policy rate to the mortgage interest rates. And that's essentially a cash flow effect on the budget constraints of borrowers with mortgages. Then the effect coming from a higher ownership rates in Spain, there's a higher ownership rates. What that means essentially is that for any given pass-through, the fact that there is in Spain there are many more mortgaged homeowners, so many more people with mortgages, essentially also means that many more people are active in the market, and so there's going to be stronger responses to consumption for any given pass-through. And then I'm going to be using the model to ask policy relevant questions. And so again, a euro area-wide mortgage market, the effect that I show in the paper is that it's going to decrease these heterogeneous effects of monetary policy if the way I think about the unified mortgage market is countries issue contracts, mortgage contracts that are more similar. And so essentially this is saying Spain having a smaller share of adjustable remortgages, a more similar share of adjustable mortgages than the euro area. And this is because there's going to be a weakened pass-through from the policy rate to the mortgage interest rate. And then finally, the second counterfactual I consider relates to the ECB strategy review. So the ECB, there was a strategy review last year from the European Central Bank where they were trying to figure out, how they're doing policy and what they change and what they should change. And so they figured, there are no house prices into the euro area price index. That's something that in the US, instead, this happen. House prices are included through imputed rents, and so they're gonna introduce house prices in the near future. And so I show through the lenses of my structural model that doing so is gonna stabilize output at the cost of less stable goods inflation. So I'm not gonna go into the details of this today, but if interested, you can go have a look at the paper. Okay, so let me skip over the lit review in the interest of time and just say that the model is closest to the work of Daniel here from the job market paper to subsequent works. So in terms of the outline, I'm going to be starting off with giving you the empirical motivation for the paper, and then turning to a high-level view of the currency union New Keynesian model. I'm going to be showing you some results, and then the euro area-wide mortgage market counterfactual. So in terms of the empirical specification, where I'm going to be showing I ran local projection regressions, Jordan 2005 style, looking at 2007, 2019, 11 countries. These are the early adopters of the euro. And so the idea of the local projection is that, on the left-hand side, you have the variable of interest, y. And then on the right-hand side, you have essentially, the epsilon MP will be the identified monetary policy shock. So these are essentially OLS on an identified monetary policy shock, which in this case is the overnight interest rate swaps announcement. So this is very similar to what people do for the US with feature, the federal fund futures. And then the quantity of interest here is the beta, which is going to give us the empirical impulse response functions. Okay, so it's the percentage point change at any given horizon to a one standard deviation expansionary monetary policy shock. So what I'm going to be showing you today are results for an expansionary monetary policy shock, so a shock that is going to expand the economy and all the variables of interest in the economy and decreasing interest rates. And so, well, then there are some lagged controls. This is standard. And so what I'm gonna also showing you today is, and what I'm gonna do is correlating this monetary policy effectiveness, so how strong and effective is monetary policy across countries, in the form of, looking at the peaks of the impulse responses, so the maximum points, or the troughs, so the minimum points of the impulse response function. And I'm gonna be correlating that with adjustable mortgage shares and home ownership rates across countries. This is one way of doing that, which I do in the paper. And so here, you can see that, if I run the specification in the previous slide on the average mortgage interest rates, then you can see that, the same underlying shock, monetary policy shock to the economy is going to have a very different effect across countries, with some countries responding in their average mortgage interest rates much more strongly than some others. So you have countries like Germany who don't respond at all, while other countries like Italy or Luxembourg that are responding much more strongly in terms of interest rates. And so now the idea is, I want to correlate how strong is monetary policy. And so here is going to be, the troughs, so the minimum points of these impulse response functions. I want to correlate that with, adjustable mortgage shares and the home ownership rates. This is exactly what I do here. On the y-axis, you have the troughs of the impulse response functions from the previous slides, so how strong is monetary policy in each country. And on the x-axis, you have the level of these institutional details of the housing and mortgage market. So you have the share of adjustable remortgages, and various measures of home ownership rates. So home ownership rates, a fraction of people, of homeowners with mortgages, a fraction of people without mortgages. And as you can see, is that the more on the right you go on these graphs, so the more, the higher the level of adjustable remortgage shares and home ownership rates, the stronger is monetary policy affecting those countries in terms of mortgage interest rates. So you have countries like Spain, which are always on the bottom parts of the graph, on the right part of the graph, because Spain has a higher ownership rates, higher adjustable remortgage shares, and so on, and respond the most. Okay, but then I can show the same for all the other variables of interest. So here is newly issued mortgages in terms of volume. And again, as you can see, the countries that are more on the right on this graph, so higher level of institutional details of the housing and mortgage markets, are also those countries that respond the most in terms of newly issued mortgages, are going to have the most newly issued mortgages following the monetary policy shock. Same for price to rent ratios. So countries who respond more to price to rent ratios following monetary policy shocks are those that are more on the right of these graphs, and same for aggregate consumption. So the takeaway is essentially countries that are the strongest responses to monetary policy are actually those countries that have higher adjustable mortgage shares and home ownership rates. However, there's sort of an identification problem, sort of a multicollinearity problem, what I showed you here, that essentially there's this strong correlations that countries that have actually high share of adjustable mortgages are those same countries that have higher home ownership rates. And so given the empirical analysis, it's hard to tell, what's really driving these results. Is it because, the countries have a high adjustable remortgage shares, or is it because they have a higher home ownership rates? It's hard to tell empirically, and so that's why this was going to be the job of the structural model. So introduce a currency union New Keynesian model with the idea to tease out these two effects, channel coming from adjustable rate and home ownership rates. And so I'm going to be, very detailed in having rich household balance sheets. And in particular, the model is related to two strands of the literature. One, which is essentially this home-foreign type of models from international finance, where, home is sort of a small open economy, and then foreign is a big closed economy. And so think about home as Spain and foreign as the euro area. And so I follow on this, Fayamanacelli 2008. And then I'm going to be tractably embed rich housing and mortgage market characteristics into the model. And this is mostly following Daniel's job market paper. And so what's the novelty of this model here is that, I can essentially look at the monetary transmission mechanism across the euro area, and then seeing, what changes in the monetary transmission mechanism if I change specific details of the housing and mortgage market, say in Spain. And so that's exactly what I'm going to do. So changing in Spain, the share of adjustable remortgages or of ownership rates, and see how the monetary transmission mechanism changes. And so let me just give you, some the main characteristics of the model. The first one is, again, I'm going to introducing a mix of adjustable and fixed rate mortgages. This is to match it to the data that I showed you before, where you see all these, differences across countries in the euro area in their adjustable remortgage shares. And so the idea is that this is a fixed share. I'm going to model a fixed share of adjustable relative to fixed rate mortgages. And this is mainly due to institutions. So, and I have a couple examples in the paper. So if we think about Spain, for example, up to 2015, Spanish banks could actually not issue any fixed rate mortgages because of they could not access swap contracts. Whatever the reason was, essentially they could not issue fixed rate mortgages, and no wonder that Spain is all about adjustable rates. And so that's what I'm going to have in my model. That's going to have this mix, this exogenous mix of adjustables versus fixed rates. And then I'm going to have ownership rates. And the idea here is that a bunch of agents in the economy, borrowers and landlords, are going to face heterogeneous shocks in their utility from owning. Essentially, when they wake up in the morning, they want to be, they have some utility shocks in wanting to be renters relative to owners. And the idea here is that Spain is going to have a higher ownership rate in the model than the euro area, because essentially households are going to be happier to own or have this higher average owning utility. And now think about these differences in ownership utility as reflective of a bunch of features that are institutional details of each market. Say renter market quality, which is very high in Germany, but very low in Spain, where people do not want to be renters, or subsidies to ownership rates, which are very high in Spain, for example. Okay, so here I show some results. I'm not going to be discussing, about the calibration, but I gave you an idea. I'm going to be essentially matching mostly, most focus on, home ownership rates and adjustable remortgage shares. And so here I'm going to be looking at a monetary policy shock, which is decreasing the nominal interest rate on impact by 1%. This is a shock in the euro area. And so as you can see, essentially Spain is going to inherit this shock, because essentially that's what happens in a currency union. Right? They face the same nominal interest rate. And then this shock to the nominal interest rate is going to essentially have different implications for average rates on mortgages, where you can see that in Spain, there's going to be a bigger response in average mortgage interest rate following this monetary policy shock. And then, in Spain, there's going to be, which is the red line, in Spain is going to be a bigger responses in newly issued mortgages, bigger responses in price to rent ratios, and bigger responses to aggregate consumption. So the idea is that in the paper, I go into the details of why this is happening. So what's coming from adjustable remortgage shares and what's coming from homeownership rates. In the interest of time, I'm not going to go through those figures. But essentially, I want to say here that essentially, the fact that Spain has a high adjustable remortgage shares, that's going to drive these big responses in average mortgage, these big differences in average mortgage interest rates. Obviously, in Spain, it's all about adjustable rates. And so, the transmission to average mortgage interest rates is much stronger. But Spain has also a higher ownership rates. And so what essentially the main result is that, if we want to focus on aggregate consumption, which is what mostly macroeconomists are interested into, then you really need both a high adjustable remortgage shares and a higher ownership rates to be able to explain from the data these big responses in consumption. Okay, so now that I gave you some intuitions on the results of the model. So let's go to some policy relevant counterfactual, which is looking at the euro area wide mortgage market. Now there's in the euro area there's a lot of discussion about benefits of having a stronger European fiscal union, which actually exists, but it's fairly limited at its current stage. And so what I focus here is actually, looking at mortgage markets. Now, mortgage markets are very local in nature. For example, it's impossible to go to be in Germany and asking your German bank to get a loan, a mortgage to buy a house in Italy or in Spain, for example. They will tell you, just go in Italy and Spain and just ask a bank there. So these markets are very segmented. And so the idea of my counterfactual is to actually look and try to decrease these barriers across countries and make financial regulation a little bit more similar. So here what I do is essentially countries can issue contracts that are more similar in their proportion of adjustable versus fixed rate mortgages. So I'm going to be showing you again the economies that I showed you before of Spain relative to the euro area, but now I add two more counterfactual economies. The first one is, I call it Spain ARM 70%, where I decrease the adjustable rate mortgage share of Spain from 90% to 70%. So I'm going to halve the difference between Spain and the euro area. And then in the second economy, yes, ARM 47%, I'm going to take Spain with its very high home ownership rates and everything else equal, but then I'm going to decrease the adjustable rate mortgage share all the way to the euro area level of 47%. So I'm going to ask, in these more unified sort of mortgage markets where, savers are going to issue more similar contracts, what's the implication on the monetary transmission mechanism? And so here I show that essentially the euro area-wide mortgage market is actually able to reduce heterogeneous effects of monetary policy. And the way I do that is that now there's going to be two more lines in the graph. One is, Spain with 70% adjustable rate mortgage share. That's the dotted line. And if you look at the dotted line, then now essentially with a decrease in the share of adjustable rate mortgages in Spain, then you're going to have a much smaller pass-through from policy rate to the mortgage interest rate. So as you can see with the dotted line, essentially the pass-through is much smaller in the average mortgage interest rates. And so what that means is that borrowers under budget constraints are going to have this big cash flow effect whereby, if you look at interest payments, they go down with the interest rate, but they do not go down as much as in the full-blown Spanish economy. So now there's going to be a much smaller cash flow effect on borrowers, a much smaller newly issued mortgages from the savers. And so if we look at the final effects on aggregate consumption, then a euro area-wide mortgage markets where, the adjustable rate mortgage shares in Spain is smaller to 70%, then aggregate consumption goes down to about 40%. And if we go to the full-blown unified mortgage market, where essentially Spain is the same as the euro area in terms of adjustable rate mortgage shares, then we're going to be able to eliminate completely the pass-through from policy rate to average mortgage interest rates, and that also almost completely eliminates the differential consumption, aggregate consumption response. So the euro area mortgage market goes a long way in reducing heterogeneity of monetary policy responses. However, there is a cost, which is obviously a redistributional cost. So if we look at, in the model, there's going to be borrowers and savers. Borrowers are those borrowing the money through the form of mortgages, and savers are those issuing the mortgages. Then, once we consider this unified mortgage market, then if we look at borrower consumption, for example, in Spain, that's very high during the expansion of the economy, exactly because these borrowers can borrow a lot of money through newly issued mortgages, they can consume more. But now with a unified mortgage market, then you can see that borrower consumption in the transition of the economy is going to be much smaller and much more similar to where the euro area households are, essentially. And so there's going to be, and then the opposite is going to be true for the savers, which do not need to cut their consumption as much in a unified mortgage market. So essentially, there's going to be a trade-off between, yes, we can decrease the heterogeneous effects of monetary policy, but there's going to be a cost to this, which is a redistributional cost of moving resources towards the wealthier households of the economy, which are the savers. Okay, so that concludes the policy-relevant counterfaction in terms of a unified mortgage market. So let me conclude. I showed you that there are strong correlations between cross-countries monetary policy effectiveness, so how effective and strong is monetary policy across countries, and that's related to these housing and mortgage market institutions. So I calibrate a new Keynesian model that accounts for the data responses of Spain relative to the euro area. And then I show that through the lenses of the model, consumption in Spain actually increases 2.4 times as much as in the euro area, very close to the data. And then a euro area-wide mortgage market is actually effective in reducing the heterogeneous effects of monetary policy, but there is some trade-off with redistribution. And finally, it's something that I didn't discuss today, but including house prices, the way the ECB wants to do, into the euro area price index is actually going to lead to a trade-off between stabilizing output and stabilizing goods inflation. Thank you very much for listening.
Great. Thank you so much, Stefano. So the discussant is Dan Greenwald from MIT.
Okay, perfect. So thanks so much for inviting me to discuss this super interesting paper. As you can see, I have no disclaimer, so you can figure out for yourselves whether my views reflect those of the Fed system. So let's jump right in. So basically, Stefano did a great job, so I'm not going to have to do too much summarizing here. He begins kind of following up on adding to kind of a long literature on looking at kind of cross-Euro country monetary policy responses and how that links to the housing market, right? And so in particular, he does these nice local projections using high-frequency monetary policy shocks, which are really kind of the gold standard these days for monetary policy shocks, to show that basically consumption, mortgage, and house price responses are stronger in countries where there are more adjustable rate mortgages and where there's higher home ownership rates, but actually what really ends up mattering mostly is just how many households have mortgages, not so much how many own. So then to kind of break down these effects, because of course there's many cross-country differences at all times. It's kind of hard to just take that and pin down. There's a strong factor structure, you could say. It's hard to pin down exactly what the single driver is. He's going to turn to a very rich new Keynesian macro housing model that actually is able to successfully reproduce, in one country's case, Spain, the fact that the responses are stronger. And in particular, he finds that this kind of higher adjustable rate share and home ownership rate interact to amplify the effects of monetary policy. You kind of need both. It's actually a very striking result. Either one actually doesn't do too much by itself. And then he has these interesting kind of Euro area experiments that I think he went over perfectly. So I'm not going to talk about them. So my evaluation is I think it's great application, right? So this is kind of, he's done a great job building this model, I think, for sure. It's, it's, when I saw it, I thought, oh, this is a perfect thing to do. It's not an easy thing to do, but it's a great idea kind of taking this kind of model and putting it in a cross-country setting. And I think it's a well-posed question. I think he's completely right that, that it really takes a model to sort of disentangle a bunch of these features. So I guess, and I think this mostly just reflects kind of the state of where the paper's at. I think it would be great to see a little more clearly where the results are coming from. So working with one of these models, you kind of build the model, you get the results. It's kind of like catching like a tiger by the tail. So it's hard to do, but you're not totally done yet. There's still quite a bit of work to be done. And in particular, the difficult part, especially when you have all these moving parts, believe me, I spent a lot of my time on this exact thing, is once you build this machinery, disentangling in a clear way where the results are coming from. So it's always part of this process. I think we're just seeing a snapshot in the production process, but I'll try to talk a little bit about what the different potential mechanisms are and how you might start to tease them apart. And then, of course, I guess in certain ways, Stefano, every paper has degrees of freedom. So some of them have been added in certain places, international places. Some features have been, kind of suppressed. And I think I'll just talk a little bit about a lot of potential things that could be done in terms of kind of enriching this, because there's many different ways that European countries potentially differ or other mechanisms that could come in. So let me give a bit of background. The kind of question in this paper is how changes in interest rates, or you could think about other shocks too, transmit through the mortgage market and how that might vary potentially by country. So the way that I always think about this first is I kind of break it down into two main bins, right? There's kind of a cash flow channel and a credit channel. So what is the cash flow channel? The cash flow channel has an idea that some mortgages, like those with adjustable or floating rates, just have payments that have load differentially on the current interest rate compared to like fixed rate mortgages, right? So this is just like literally like a cash flow thing. Basically, if you have an adjustable rate mortgage and rates go down 1%, let's say your mortgage is like $200,000 or 200,000 euros, then a 1% decrease, a 1 percentage point decrease in the interest rate is going to decrease your payments by like 2,000 euros a year. That's just money that you save in your pocket, right? Of course, it's not money that's generated out of nowhere. It's money that you no longer pay to your lender. But to the extent that your lender has a lower MPC than you, which is our typical assumption, or if your lender is even out of the country or something, you're going to see a boost on net consumption because the borrowers often spend a lot. The lenders may not adjust that much. And what you're going to get is an increase in total demand, total consumption. Okay, so this is kind of a very valid and important point. It's been studied quite a bit. So this is kind of one of the points of Adrian Auclair's job market paper. And in the kind of Euro-specific context, or in kind of looking at arm shares more generally in kind of a new Keynesian setting, Calza, Monticelli, and Straka, and Margarita Rubio have papers kind of looking at this already. So then beyond that, there's what I would call the credit channel, which is that shocks, in addition to just like this is the cash flow channel is kind of holding the existing mortgages fixed. So everyone keeps their mortgage. And even keeping your mortgage, you're going to see the payments go up or down depending on what's going on with rates. That's going to depend on the mortgage structure. The second part is what I would call the credit channel, which is the idea that after these shocks, borrowers may increase or decrease their mortgage balances. Okay, they may get new mortgages or different mortgages, right? And so in the framework that this paper was built upon, was really designed to capture actually this part more than the cash flow part. And so how can this occur? One way is that credit limits can change. So for example, shocks to the economy can endogenously increase house prices, which can endogenously relax loan-to-value limits. I wrote it in the US context, so monetary policy shocks that move interest rates. Well, interest rates really affect payments income or DTI limits, which are very common in the US. What's the idea? Basically, if you have a cap on your interest payments to your income, then if the Fed does something or the central bank does something that lowers rates from 5% to 4%, every dollar of debt now has 20% less interest on it. So you can borrow a lot more, actually, while still maintaining the same payments income ratio. It can also come through the increased propensity to borrow. So we had a great session about mortgage prepayment and refinancing, right? We know that moving rates around potentially has a big impact on either refinance rates, most important for consumption, or probably cash out refinance or new purchases. Otherwise, it kind of ends up going through the cash flow channel. And all these channels basically have potentially very strong stimulus effects. Well, if you remember my logic, moving rates by 1 percentage point, it kind of saves borrowers, let's say 2,000 euros a year on a 200,000 euro mortgage, or 200,000 dollars, the same thing. But potentially this credit channel can be very strong. If you get one borrower to do a big equity extraction or to see their kind of maximum payments income limit relaxed a lot by a big drop in rates, they could easily be borrowing in the tens of thousands of euros or dollars, right? So this can actually deliver a lot of resources to borrowers at once. This can actually be very important for persistent shocks because a lot of times persistent cash flow changes actually end up getting washed away by our typical, new Keynesian frictions, which work really well at short horizons. But the stimulus that you get from having your mortgage payments be 2,000 euros a year lower in 3 or 4 years in most models is very small, whereas this delivers a lot of resources right away. So one question I had, first of all, is kind of which channel drives the results of the paper? So on the cash flow side, I think there's a very clear mechanism here. Perfect. Which is that adjustable rate mortgages have payments that fall with nominal rates. And of course, the more adjustable rate mortgages you have, the more borrowers who see their mortgage payments fall. And of course, the more mortgages there are in general holding the adjustable rate mortgage share fixed, the more adjustable rate mortgages there are. And then, the more people have their payments fall. And so for a country like Spain with a high arm share and high home ownership, and as a result, high mortgage ship, if that's a word, the cash flow effect should be stronger. Okay, so I guess I was kind of wondering, is this the main effect? So if so, the contribution is definitely non-trivial, like James said. It's easy to get, you could do the back of the envelope thing and still get rejected very easily, even if you counted really well the share of adjustable rate mortgages and how much all their payments will go down following a shock and whatever. So having all the GE stuff in there is great. But to some degree, what the paper would then be compounding is kind of, let's say, back of the envelope math of like, number of adjustable rate mortgages times drop in rates times size of mortgage, whatever, and then passing that through in some way like a GE multiplier and kind of, it wouldn't be as ideal, but you could imagine doing the first part from the data and getting the second part from like Valerie Ramey or somebody and kind of getting a similar result. So again, it's not trivial. I think it's great, but I think that So the first thing I think that would be good to do is just to clarify this channel. And an easy way to do this in these models is basically, you can just freeze the credit limit. So basically just say, okay, let's pretend we live in a world where credit limits are not given by LTV limits. They're just M bar. Everyone can borrow some number, and we're just going to freeze that number. Because if that number never changes, the only thing that's left is cash flow effects. And so that would be a really easy way to kind of cleanly pick it up. Not because this is a real economy, but just because it's like a good thought experiment. To the extent the results do come from the credit channel, it's always good to understand how. There's different things coming from potentially the stream of future housing services, the household SDF, or latent demand for credit is a particularly tricky one. Like, how much do households really enjoy the collateral services that come with a house? And there's various ways to decompose this. That would be really helpful in this case, I think. The second thing is to think a little bit about the potential mechanisms here. So again, kind of this model, although I'm not sure exactly whether the effects are coming from the credit channel or the cash flow channel, was kind of really developed the base model that I wrote. Of course, Stefano has augmented it and improved it in many ways to really think about the credit channel. And the way that I did this was I had 3 different mechanisms at the time. One is that higher house prices can endogenously relax LTV limits. Second is, dropping interest rates can relax payments income limits. And the third is that low rates can encourage higher refinancing or transactions, right? So the current paper features the first one and kind of kills the second and third. So I don't blame Stefano at all for this. It's already a kind of a big machine. I think this is maybe not a suggestion for this paper, but I do think that there might be differences in these other mechanisms across Euro countries as well. So I'll just highlight this as another place to the extent that maybe the credit channel might actually be less important for this paper. I think the machinery is already there. I know Stefano is like a super model builder. This would probably take him a week to add these features in. There potentially is very low-hanging fruit here to study these. So for example, I do think that these payments income or debt service limits exist in the Euro area. I think it varies potentially quite a bit across country. That could be another very interesting margin to look at across country. And same with the refinancing thing. So a lot of European countries compared to the US make it more difficult to refinance and in particular to extract equity. Not all. But the other thing that's relevant is, of course, sometimes you can have these kind of stealth refinancings. I mean, not really literally, but in a lot of countries, you can't extract equity, but you can move. And when you buy a new house, basically, if you change houses with your neighbor, you guys can both effectively extract equity. So looking at how that features in, and if that response to rates may be relevant. The last is kind of an international angle, which is this is an international paper, but it wasn't totally clear to me to what degree the international trade part was bringing in. And so obviously there are a lot of Euro experiments that are very relevant, but my question was kind of well, if we had instead of 2 economies like Spain and Europe linked by these international flows, you could also just model a world where you have 2 separate closed economies. And what I was wondering is to what degree we get the same answers or different answers. This is a kind of a major comparative advantage of this paper, so it'd be great to see the contribution. One thing that really popped into mind, and I will try to wrap up on time, is that one special thing about Europe and the Euro area is in a lot of our models with closed economies, shocks that affect housing demand, they start to trigger all this consumption, and then the central bank is actually fighting that very hard because they actually don't want this kind of demand side stimulus for no reason or whatever. In a Euro system, that's actually going to be quite different because the central bank will not be reacting nearly as strong to shocks in an individual country. So if Spain is having this very strong amplification, but Germany doesn't because they have a very different home ownership rate and mortgage system, that's something that actually will really be kind of interesting and kind of unique to this setup. So I think that's great. So let me wrap up here. I think it's a rich and very well-constructed model. I think the question's good and the experiments are good. Of course, it's a huge model, so it always takes a while to really wrap up everything that could possibly be done, and there's low-hanging fruit for lots of other stuff that could easily be done. So I'll wrap up here. Thanks very much.
Great. Thanks, Dan. Stefano, so why don't you come up, maybe just take a minute to respond to Dan, and then we can take some questions.
All right. Well, Dan, thank you very much for the super nice discussion. So let me just maybe, so all the points are very good points, and indeed there's a little bit more to do on the mechanism, especially in the credit channel. That point is well taken. So regarding, just want to do a brief comment on the international finance aspect of the paper. So you're right that essentially the international finance aspect, that's something that I do like right now, but maybe I shouldn't. That doesn't really matter much. So this could well be two closed economies where Spain, essentially, you impose in Spain the same process for interest rate that happens in the euro area, and then the same results will show up. So the idea is that here, well, the idea of the model there is that Spain is a small open economy. So, of course, anything that happens in Spain is not going to have effects on the euro area because it's a small open economy. But in the euro area, which is this big economy, then it's a closed economy, then movements in output in the euro area are going to have an effect in Spain, in this setting, through essentially home bias in Spain. But that turns out not to be an important channel, quantitatively speaking. And so indeed in the calibration, I discussed it a little bit. If you set the home bias to 1 completely, which also closes down Spain completely, then you will still observe the same results. So essentially all is driven by the differences or movements in adjustable rate mortgages or ownership rates rather than these aspects of spillovers between euro area and Spain. So having said that, we can discuss later on other points.
Great, thanks. Are there some questions? If not, I have, Igor?
Just a technical one. I saw that the price dropped in Spain in response to house price, or is it price to rent ratio in response to an interest rate decrease? How come?
No, there's an increase in price to rent. You mean in the model, maybe? There's a very small decrease at the beginning, but then there's an increase. So, the main effect is an increase in price to rent following an expansionary shock, which is also what happens in the data. Yeah.
I just didn't understand. The first 2 periods it went down, and I couldn't figure out why.
Yeah, the on impact. This also happened empirically in VAR's model, where at the very beginning you might have a drop, and then things go the direction they should be. That happens in the model as well, because because rents fall less than house prices, and so you have at the beginning, and so you have a decrease, but then you have an increase in price to rent ratios over after the second quarters or something. That's a good point. Thank you.
I was interested to get your impression as to what you think the kind of key institutional drivers of the sort of mortgage contract design are. I've asked other people this, but do you think is it kind of primarily about the availability of covered bonds, or is it my impression is Northern Europe has a higher prevalence of sort of longer term fixed rate contracts compared to Southern Europe, but interested in any thoughts you have on that.
Yeah, so it's hard to say. I think there are no papers trying to that look at this, right? Because the point is that given the data availability, people haven't figured out really what are the institutional details that drive these big differences in adjustable rate mortgage shares across countries. There are also big reversals going over time. For instance, I said that essentially in Spain till 2015, banks could not issue fixed rate mortgages, but now they can, and now there's a big reversal. Now all banks are actually issuing fixed rate mortgages. These differences seem to be coming more from the banking sector, or maybe the level of competition there. It's something that's understood, but that's my hunch. It's like the banking competition and banking sector relative to households' demand. So essentially right now, I think in Germany, households can only pick fixed rate mortgages. And that's why there's this big share of fixed rate mortgages relative to adjustable. Yeah, thank you for the question.
Luke,
Lou.
I was just wondering, your counterfactual was about homogenizing the armshare across these countries. And I don't know, I would guess that the kind of heterogeneity across countries, like the output gaps across countries, actually may line up with what you would want as a policymaker. So Spain possibly having a larger output gap than Germany, and maybe you would want that. So homogenizing the armshare may not actually be an optimal policy.
Yeah, so I don't discuss, what an optimal policy is. I just take these features as given. And then, since actually in some of the speeches I report one, or I reference one in the paper, policymakers seem to be concerned about the fact that there are these big heterogeneous institutional settings, not only in the housing and mortgage market, but also in the labor market. And that might be problematic from my point of view, at least. They don't say why, but in my point of view, it might be problematic because if these big differences in the settings, institutional settings, lead to differences in responses to monetary policy, then in period where you need to increase interest rates, like in the upcoming quarters for the euro area, for example, then you're going to have a recession in Spain, which is going to be much bigger than the recession that Germany is going to have. That's not necessarily something that you want. So, that's stuff to think about. But surely it's an important point. Thank you.
All right, Stefano, thanks. We'll leave it there. Appreciate it. So our final paper, we're going to sort of turn to sort of thinking about labor market effects. So the paper is household leverage and labor market outcomes, evidence from a macroprudential mortgage restriction. And the one and only Kasper Roszbach is going to present the paper.
Okay, thank you all for holding out for this last presentation at the conference. Thanks also again to the organizers for including our paper. This is a joint project with Gazi Kabas, who's also in the room here. Gazi is currently a postdoc at the University of Zurich. He's starting as an assistant professor in Tilburg in August. So it's great to have him here as well. And thanks also to the organizers for accommodating that. So I'll talk about household leverage and labor market outcomes, evidence from a macroprudential mortgage restriction. So I probably don't need to say that household borrowing is of great importance to the economy with some well-known benefits and some well-known costs. But I do think that the financial crisis, and it just seems incredibly distant right now, but the financial crisis did make this role of household leverage and job displacement for the economy more salient than it was before. We know now, we know a lot of things about the role of credit, but we know that credit growth is a robust predictor of financial crisis. We know that rising household debt over GDP presages lower GDP growth. And these kind of sort of new insights that we obtained have led many countries to introduce policies to prevent sort of the perceived costly buildup of household debt. And if you look at this map over countries that had a macroprudential policy that was directed at limiting household leverage some 7-8 years before the financial crisis, there weren't a whole lot of countries that actually had these kind of policies. Now, if we move like 20 years forward and we go 10 years beyond the financial crisis, then basically, many or maybe most advanced and emerging economies had implemented macroprudential policies to address these increases in household leverage. Now, the research that has been done on macroprudential policy, in my view, has mostly sort of focused at understanding how these policies that limit household leverage affect financial stability. A bit less at what the mechanisms are that are driving these results, and maybe a little bit less on sort of what potential side effects these policies have had. Some recent work has started looking at these side effects of macroprudential policies. There's a really nice paper by Zurich, who was at the Dallas Fed. It's a paper that's circulated for a long time that looks at how borrowing constraints or how macroprudential borrowing constraints limit geographical mobility in the housing market. And a couple of colleagues of mine in Norway have sort of looked at the liquidity effects of macroprudential borrowing constraints and found that an LTV, introducing an LTV sort of reduces liquidity buffers among households and thus sort of reduces their ability to withstand future economic shocks. Now, the real challenge, I think, for macroprudential policy is to find this fine balance, to trade off the cost of restricting lending in good times against the expected benefits of a slightly or substantially larger bust in bad times. And because of sort of these new insights and because these objectives of macroprudential policy, we're going to try to take a slightly different perspective on household leverage in this paper and investigate if household leverage affects wages through its influence on job search. And we hope that the insights from our paper will not only sort of make us understand better how household leverage affects labor choice, but also to be sort of helpful in informing the calibration of macroprudential policy and to help us develop better tools to cope with the consequences of household leverage. So before we start with that, it's maybe useful to, without going through the whole literature on household debt, to give you sort of a sense of, what do we actually know from theory about the relationship between household leverage and wages. Actually, theory gives us, offers at least opposing views on the effect of leverage on wages. On the one hand, there's a group of people, including Donaldson and co-authors, who argue that household leverage will actually increase wages. And the argument here is that higher leverage creates a kind of debt overhang effect, which reduces the willingness to work of households. And because there's sort of a limited liability effect, that when you have higher debt and you start working more, you're basically just spending the money on your loans and you don't gain a lot of pleasure from it. And this leads workers to demand higher wages to be properly incentivized. On the other hand, there's people like Chetty and a recent paper by Baji that argues that household leverage will actually reduce wages. And their argument was one of sort of liquidity constraints that are induced by higher leverage. When leverage increases, you're sort of more constrained in your cash flows, and the probability that you will eventually default rises. And because of this higher risk of default, you're much more inclined to accept earlier but certain job offers instead of waiting for later offers that might possibly offer a higher wage. So because of these different views in the literature, the question or the answer to the question of the effect of household leverage on wages is really an empirical question. And we're going to try to offer at least one answer to this question in this paper. So to investigate this question of how leverage influences job search and wages, we're going to use three ingredients. I'm not going to spend any time on the details, but it's basically data, shock, and sample. So regarding the data, we're going to use highly granular individual level labor market data and household balance sheet data from Norway. We're going to combine that with the introduction of an LTV constraint in Norway in 2011. And then we're going to focus on a relatively narrow group of workers, displaced workers who recently bought a house after the introduction of this policy. Just the findings, sort of in summary, when we asked this question, tried to answer it with the Norwegian data, we find a confirmation that a reduction in household leverage induced by this LTV constraint improves wages. In fact, sort of an average 25% decline in the debt to income ratio because of this macroprudential policy improves wages by 3.3 percentage points. And the lower leverage enables the workers that are affected by this policy to search longer for jobs, but also to find jobs at better paying firms. And these displaced workers with lower leverage turn out to be more likely to assume a new occupation at their new employer following unemployment, but also more likely to switch to a different industry. And in line with the idea that sort of lower leverage sort of alleviates friction in the labor market, we find that this effect is stronger for younger people, for more educated people, and for displaced workers who had a shorter job tenure, so the people who have less firm-specific human capital. Okay, about the empirical strategy then. So obviously we don't have like a super ideal experimental setting. We cannot create an ideal experiment. But for our purpose of estimating the causal effect of household leverage on labor market outcomes, we basically need two ingredients, we just need these two things. And one is we want to have job search behavior that is not induced by individual characteristics. And we'd also like an exogenous shock to household leverage. And we're going to try to do that by using this introduction of the LTV constraint as a shock to household leverage, not surprisingly, and by focusing on a particular group of displaced workers who recently bought a home just before losing their jobs. So let me say a few more things about both the LTV constraint and how we define displaced workers. So the reason why we care about the precise definition of displaced workers is that even though we have a lot of granular data and a lot of background information about these Norwegian workers, we don't know everything about them. So there is always this risk that unobserved individual characteristics might be triggering job switching. And if this interacts with the LTV constraint, then that would sort of ruin our results. So what we do is we're limiting ourselves to people who lose their job in a mass layoffs as they have been defined in the literature, to avoid that the job search is actually caused by your own decisions or your own background variables triggering job loss. So in our data, a worker will be considered displaced if he or she lost a job in a mass layoff, where a mass layoff is defined as a firm reducing staffing by at least 30% in a particular year, or fully stopping existing during that calendar year. So here we're probably mostly thinking about companies who close a branch or maybe close a subsidiary where a lot or all of the employees are being laid off. Then some details about the LTV constraint. So the reason why the Financial Supervisory Agency introduced this LTV constraint in 2011, it was that house prices, as in many countries, had been rising very rapidly, and household debt levels had also been rising very quickly. So the LTV constraint imposed an 85% cap on mortgage amounts relative to the home value for this particular person, and covered all loans that were provided on this particular property. So as a result of this new policy, some workers ended up having smaller mortgages than they would have liked to. And by combining this sort of definition of the displaced workers in mass layoffs with the LTV constraint, we hope that we're able to address these two important empirical challenges. Okay, let me take this really quickly because I need to think a little bit about time, but we need to impose one more constraint on our data, and that's for the following reason. So the policy obviously only affects home buyers. So we're only looking at home buyers here. But one potential risk we might have is that if changes in wealth occur at the same time as this LTV policy is introduced, then our results could in a way be diluted because some workers who lose their jobs might be accumulating unobserved wealth to us, wealth that is unobserved to us, and might therefore be sort of dampening the empirical or the measurable empirical effect of the policy. So what we do here is that we restrict ourselves to a particular group of displaced workers, namely those workers who bought a house not more than 12 months before they lost their job. That sort of gives us the best probability of not having unobservable home equity in a period when house prices were rising. And then we followed, so we look at home purchase, job loss, and then we measure wages as the difference between the old employer and the new employer. Okay, another thing that's important about the analysis, is that this policy applied to all Norwegians, so all potential home buyers. And that means that we do not, as in some other settings, have one variable that tells us who belongs to the treatment and who belongs to the control group. What is important is that there are both people that are affected and not affected by the policy, but we need to figure out how they work. So how can we do that? How can we distinguish the affected from the unaffected ones? Well, what we're going to do here is that we're going to use data from the pre-policy period and use the background characteristics from those people and their decisions on LTVs to do a prediction of whether people would have preferred to take a high LTV ratio on their house or not. And we're going to do that with machine learning exercise or algorithm. We're going to do it with a random forest. I'm not going to spend any time on that. What's important here is that this random forest is really good at classifying borrowers in the pre-policy period. So the algorithm classifies 82% of the pre-policy observations in the right group, below or above 85%. Okay. So with these generated LTVs, we're going to start looking at two things, the debt to income ratio and wage growth. Now, there are two things that are important here because houses are bought by couples, and many times we're going to look at the debt to income ratio at the household level, not at the individual level. Then we're going to follow the individual worker, of course. And we're going to measure wage growth as the change in the wage rate, as in the wage between the job before displacement and the new job after displacement. Okay, so let's start with a quick sanity check of this policy. This is the introduction of an LTV ratio, and that basically limits people's ability to borrow. So what we should see is that the introduction of a LTV ratio should reduce the debt-to-income ratio for these workers. And in this sort of standard event study chart, where we see the difference between the DTI of affected and minus the non-affected displaced workers, we see that before the introduction of the policy, the difference between the affected and non-affected workers is basically constant. So this is normalized at the year before the introduction of the policy. But following the introduction of the policy, we see that the DTI of the treatment group follows relative to those that were not affected. In terms of regression results, what you can see here is on the upper line that irrespective of sort of the saturation with fixed effects, that the effect on the debt-to-income ratio is substantial. So the introduction of the policy basically reduces the DTI by one annual income. So the mean debt-to-income ratio is about 4.25. The policy reduces the DTI by about one annual income. So to on average 3.25. And the effect is significant. So then let's go over to our real variable of interest to look at wage growth. And I'm just showing you a similar graph as before here, an event study graph where we take the difference between the change, between the wage growth of the treatment group minus the wage growth of the control group. And as before, we see that basically treatment and control are on a similar trend before the introduction of the policy. The difference between these two groups in wage growth is constant, but after the introduction of the policy, we see that the treatment group experiences a relative increase in wage growth. And now we'd like to know what this change in wage growth is in numbers. So we're going to look at the effect of the estimates from our difference in difference regression. So on the upper line here, what you see is the relative increase in wage growth of treatment group versus the control group. And what we see here is that treated households, so those households who would have liked to take a relatively high LTV, but are forced to keep themselves below the 85% LTV ratio, actually experience an increase in their relative wage growth relative to the control group. So the coefficient of 0.39 here in the last column is a relative change, or is the fraction of the mean change in wages that displaced workers experience. And so it's important to keep in mind here that displaced workers don't raise their wages when they become unemployed. They typically get a lower wage in their second job. And this is the number that you see here at the bottom. So the average fall in wage for displaced workers is minus 7.5%. Those displaced workers who are forced to reduce leverage because of the LTV ratio, they experience a relatively smaller decline. So it's 3.3% smaller decline in wages following unemployment and following the introduction of this policy. They still experience a decline in wages, but it is a much smaller decline in wages. Now, one thing that is also important here is, or might be important, is that we would, of course, in an ideal setting, like to compare workers who were laid off from a firm after the introduction of the policy and workers that were laid off from the firm before the introduction of the policy. But for obvious reasons, namely that very few firms have mass layoffs in a very short time window, both before the introduction of a policy and after the introduction of the policy, we cannot sort of conduct this ideal experiment. So we cannot control here for firm fixed effects. So the best thing that we can do here is to control both for location fixed effects and industry fixed effects, which might be important if we believe that mass layoffs, for example, could be triggered by local economic shocks or by industry-specific shocks. But we see at least that irrespective of how we add fixed effects, that the quantitative effect of the policy on wage growth is quite stable. Okay. One concern people might have is that introducing an LTV constraint by itself creates a problem because of endogenous selection into the housing market. And why is that? Well, that's because some workers will, of course, because of the LTV constraint, not be able to afford a down payment. And that could lead to different people buying houses after the introduction of the policy than before introduction of the policy. So said in different words, the characteristics of the treatment group could actually change after introduction of the policy. Now, we cannot control for this completely, but what we can do is that by using data on house purchases and liquidity buffers, bank deposits of households before the policy was introduced, we can actually exclude those workers from the data that would not have been able to buy a house, make the down payment, had the policy been introduced before the actual introduction, so in 2011. So what we do essentially is that to make sure that sample selection, because of people not being able to enter the housing market, will not bias our results, we take out those people from the pre-policy period that would not have been able to buy a house had the policy been introduced. And when we do that, we see that our results are not changing. Thanks. Okay. This is a short presentation, so I can't tell you too many things about robustness checks. Let me just say that we do several robustness checks. And maybe 2 or 3 that I could mention here is that we are interested in eliminating some of the people from the data that might not have the same relationship with the job market as us normal citizens have. So what we do is we take out people from the data who receive substantial inheritances in the sample period. We can observe these inheritances from the tax filings, but we also remove people from the data who earn business income. So people who earn business income can actually both manipulate their official income data, but they can also choose to work in a different way than what we typically do. What we also do is that we check if macroeconomic conditions might be interacting differently with the treatment and the control groups, and we see that these do not have any important effects on our findings. So I do want to have a chance to say a few things about the mechanism, because that's important here. So there are essentially 3 ways in which leverage could affect wages. One is simply through the duration of the unemployment spell. So what could happen is that, by having lower leverage, you're just able to wait longer for job offers. So you don't do anything actively. You just wait for offers to come in, and that gives you, at some point, a better hit and a higher wage. Another possibility is, of course, that when you have lower leverage, you might have better access to the credit market when you become unemployed. So you get more liquidity, and that allows you to sort of survive through that period and search in a different way. And the third mechanism could be that, because you search longer, you're able to use that time and search actively for different kinds of jobs. So different firms, different industries, or different locations. And we look into these 3 alternative mechanisms. So I want to go through it quickly, but basically what we do here is that we look at the duration of the unemployment spell. We look at post the introduction of the policy changes in credit, and we look at firm-specific wage premiums. And what we see here is that, unemployment spells do rise for these affected workers, but we do not see an increase in credit. So the changes in the duration of unemployment and the changes in the duration of search are not driven by an increase of the take-up of credit during the unemployment period. What we do see is that these workers actually end up getting jobs at firms that pay higher wage premiums. So this is the AKM wage premium that people typically use in the labor literature. So it's basically the premium that a firm pays while controlling for the quality of workers and controlling for the quality of the firm. I'm going to use 1 or 2 minutes to conclude. Am I still within my budget constraint? Thanks. Okay. So lowering financial risk can allow workers to take more time and maybe some more risk while searching for jobs. So let us look at the extent to which workers are broadening their job search. So we're going to look at these things that I mentioned at the beginning, namely the occupation, industry, and location of firms. And here we see, of jobs. And what we see is essentially that workers that are forced to reduce leverage, they actually are 30% more likely to choose a different occupation at their new employer. They're also much more likely, 23% more likely to start a job in a different industry than where they were working before. But they're not looking for jobs or at least not taking jobs in different locations. So actually, it's a sort of bit related to some of the work that Asaf has done, is that in the literature or in the paper that you have about negative home equity, labor mobility is reduced. Here we don't see a positive effect on labor mobility because of this longer job search. So there's some heterogeneity here also, and I just want to, for the sake of time, stick to the last line here and say that if a lower leverage reduces frictions in the labor market or alleviates frictions in the labor market, then we would think that some people might benefit more from these options of improving job search. And one thing that we find here is that young people, people with low job tenure, so relatively little firm-specific human capital, but also better educated workers and those with lower incomes are actually the ones who are driving most of our results. So let me conclude here and say that we find hopefully convincing evidence that household leverage affects labor market outcomes through its influence on job search. The reduction in household leverage improves the wages of displaced workers, and these workers end up having longer spells between jobs, find jobs in better paying firms, and they also broaden their job search. What I did not show, but what we do find is that this effect is not associated with an increasing volatility. So it's not the case that you find jobs that pay better, but you're more likely to be fired afterwards. So, if you think about these results in the context of macroprudential policy, then macroprudential policies that limit household leverage are not only bad for young people. They turn out to have some positive side effects, and they are located in the labor market. And we hope that these results will help us understand a little bit better, how leverage, for example, influences the dynamics of economies that might be sort of facing a recession and have either a high or a large share of people with high leverage. Thanks a lot.
Great, thanks. So the discussant batting in the cleanup position for the conference is Asaf Bernstein from UC Boulder.
And thank you so much to the conference organizers for letting me discuss such an interesting paper, and of course the authors for writing such an interesting paper, and those participants who are still hanging around online in the Zoom. Really appreciate you hanging around till the end. So yeah, and as usual, disclaimers apply. These are not the views of the SEC or any of that sort of stuff, just my own. Okay, so as Kasper said, there's a prior work looking both theoretically and empirically showing that household leverage can distort labor supply, including some work of my own, right? But as James mentioned before, right, this is not really policy recommendations, right? We've just said you've got a bunch of leverage, that's bad, right? What's great about this paper, right, is it's just saying ex ante, what can we actually do, right? One simple approach, well, when people buy their house, make them put a lot more money down, right? These sort of LTV caps are growing, very common. So understanding the role they can play in alleviating the sort of effects we've seen for labor supply of high leverage is an interesting question. And as was mentioned, not obvious ex ante, right? So there's a number of theory papers. I'm not going to list them here, but you saw them in Kasper's presentation. It can push both directions depending on your incentives versus your ability to search, right? But on top of that, as an empiricist, right, there's going to be other things going on. If I make you put more money down, it could push some buyers out of the market completely. It could delay their buying, change the sort of types of houses they buy, where they buy, right? It could change the income profile of who comes in, right? And perhaps even more interestingly, could cut the income profile of someone who even stays in, right? They adjust maybe their labor or consumption in response to the new rules. That could alter their labor supply decisions and how they respond to shocks in very different and unclear ex ante sort of ways, right? And along those lines, right, what's going to happen to their leverage when you implement this rule, right? We can think about leverage in lots of different ways, but let's say you defined it as their debt over their liquid assets. Then it's not obvious to me what's going to happen, right? If I have to take my liquid assets, put that money into the house, well, now I don't have any liquid assets to use when I'm faced with a shock, right? And so depending on how we define leverage and think about leverage, it's not obvious what's going to happen, and it depends on how households are going to respond to this thing, right? In like a classic lifetime income hypothesis world, I would really be substituting my liquid savings for home equity. And so when you implement this sort of policy, it's not clear what's going to happen in net worth, right? And so understanding and thinking about this net worth response to this sort of policy and thinking about how that's going to change your financial stability to be better or worse, I think it's very unclear ex ante, and why this is a really important paper, and these kinds of papers are really important, okay? So inevitably an empirical question. That's why we've got some empiricists working on it, right? So what do? They're going to look at this Norwegian implementation of an LTV cap at the 85 to 90% LTV cap over sort of a short period when they moved that from 90 and then down to 85%. And prior to that, it looks like most households aren't putting a lot of money down. So this is going to be binding. This is going to be a big shock to overall loan to value, overall money that's put down initially, okay? Now they're going to look at wages after layoffs for recent home buyers who bought within the last year. That was very clearly explained. And what they're going to want is some sort of treatment and control. And so their treatment and control is they're going to look for people who are predicted to have high LTVs, who are unlikely to put a lot of money down. They're going to fit that using this random forest nonlinear model in the pre-period. They're going to plug in a bunch of stuff at the individual level, like income, savings, debt levels, education, age, location, immigration status, and then a bunch of stuff that's time varying at the regional level, things like unemployment rates, national, regional house prices, that sort of stuff, okay? Then they're going to compare those predicted to put less money down before versus after the reform relative to those who are predicted to put lots of money down, okay? And that's basically the identifying assumption, the empirical design in a nutshell. What do they find? I'm going to go through these quickly, right? They find a big drop in initial loan to values and therefore a big drop in household leverage, right? And these are really big changes, right? So these are big deals on DTI, LTV, interest expenses, all of these drop a dramatic amount, right? And you can basically think of these periods as just being calendar times relative to the actual regulation, right? Because there's no staggered timing. There's just one treatment of it. And this is the result of the paper in a nutshell, right? They find a rise in wage growth among those laid off for those predicted to be treated relative to those not around these layoff events, right? So they're recovering more quickly. They're having less of a wage loss in response to these big shocks, okay? Despite no change in pre-layoff characteristics, right? So there isn't this sort of pushing people out of the market. And so you're really finding yourself in a pretty good spot, right? You've gotten them to be more resilient to these sort of shocks, and you haven't pushed people out in a systematic way, right? There's no change in the observable pre-layoff characteristics, okay? And this is driven, as was said, by longer unemployment spells, therefore better matches, higher wages. And if you think about it in terms of this interest expense shock, this is facilitated by the fact that they don't have these recurring interest expenses, what we might call consumption commitments, but really these are real expenses they have to pay on an ongoing basis from the reduced mortgage balance, right? And that facilitates search, a better match, and subsequently higher wages, right? This is the narrative of the paper, which you guys just saw. All right, so let me make a few sort of high-level comments. And I honestly think a lot of these are relatively minor. So one on selection, and it's not about identification, okay? One on thinking about where money comes from and the sort of endogenous effects on their behavior, which again is not about identification. Then I will talk about identification, and then I'll think a little bit about interpretation and external validity of the findings, okay? So if we think about the selection, I really want to think about this dimension and why there isn't any of this sort of behavior in this setting, right? And I don't mean this from an identification standpoint. I mean this from a like, hey, why don't we see a response along these dimensions standpoint, taking these as truly causal, right? If we look at other settings like ability to reform laws, financial stability reforms in the Netherlands and the US, typically these papers, and this is just two, right, but there's a whole handful in this space, they see that when you require households to put a lot more money down, it's pushing some people out of that market, pushing them into other markets, right, systematically related to the amount of income they have or not. And here we don't see that, right? And taking this as true, it says there's something special either about the reform or the setting, and it would be really helpful to understand what you think that is. What's special that's going on here? And what does that say about what we can or can't translate about these findings to other settings, right? I think that would be super helpful. Two, where does the money come from, right? So they're going to buy houses that are $500,000 cheaper, okay? But mortgages that are $600,000 less. Right? So there's an extra 100,000 that's coming from somewhere, right? And that's really big, right? The median deposits for the whole sample, not even just like the constrained sample, is like 115,000, right? So this is like the size of the median, right? And yet when we look at the fall in debt to income, it's very similar to the fall in debt minus deposits divided by income, right? So there's something very interesting going on. You're implementing this big increase in the amount of money they have to put down. Okay, they're building up that liquidity somehow, cutting expenses maybe, in response to this reform. And then it goes away. That's it, right? Just a one-time response. They say, okay, you're going to make me put more money down. I'm going to save up more, put more money down. That's it. Otherwise, I'm going to look the same afterwards, right? That's surprising, but also very interesting, right? And if anyone in this room is going to be open to this idea, it's probably going to be me, right? I have some paper with Peter Kudais where we look at the effects of mortgage amortization on wealth accumulation and or other liquid savings. In that setting, amortization is about how much debt you repay over time. This is how much debt you pay right at the very beginning. We find that the debt they're forced to repay over time doesn't change their stock of liquid savings, which is sort of surprising, okay? And that could be consistent maybe with what you see here. Again, it's not changing their stock of liquid savings after they actually make the debt repayment, right? It says something about the wedge and the marginal propensities to consume out of liquid versus illiquid savings, okay? So I think that'd be really interesting. If you wrote down a model, I think this would be kind of a key parameter to think about what the labor supply response may or may not be. Otherwise, it's going to be conflating multiple things going on at once, which is fine. I just think it's important and interesting to think about. Okay, let's talk about identification. I'm going to be completely unfair here and do a caricature of the paper, right? But maybe you can imagine you're almost thinking of, okay, the treated group is poor, the control group is rich. We're going to compare how poor versus rich homeowners deal with layoffs early versus late in the sample. That's it, right? I mean, and if you look, in the earlier period, there definitely is differential response to layoffs among this group, right? It's not like as if I had as if random assignment along all dimensions, right? And so this is a pretty high bar, and you worry about the sort of concerns that was talked about here, selection on who enters before versus after, right? Now, one approach, which I think was very clever, is take the people who have plenty of money. And if you take the people who have plenty of money, you don't see as much sort of pre-period selection, so that's nice, and I would emphasize that more if I were the authors, right? But I think there are still some concerns, right? Any reform or macroprudential policy or whatever that leads to differential response among these groups in the pre-period versus the post-period and is unrelated to this regulation, of which I think there are probably a few you could think of, is going to be potentially concerning, right? And so what I would love to see is, in addition to what you have so far, is a little more on the distribution of buyers across a broad set of characteristics before, first, after, some placebos with non-homeowners where their income responses to these shocks among those groups differ, and then some maybe non-linear effects around this cutoff, right? So just generally speaking, predictors don't really have an effect unless it's near where you're going to see treatment, okay? And finally, in terms of external validity, right? This is a real rough sample, right? These folks just bought a house, like in the last 12 months. Could have been like last month. And then they get laid off from their jobs. That's brutal, right? And then we're going to look at the response, right? I still think it's super interesting to look at like the most brutal situation you can imagine. But if we think about external validity more broadly, what are the effects? I would love to think about other groups as well, right? So I don't think there's any reason you have to look at people who just bought their house, right? While it's true there's going to be home equity appreciation and not, one, it seems sort of secondary to your story since you're really talking about, it looks like it ends up being monthly payments, not the actual amount of home equity that matters. Two, you could always do it within like a two-stage lease to heirs framework. We're using when they're buying and then as an instrument for the amount of home equity or not, right? So it doesn't bother me that much that you're going to have mismeasurement as long as you deal with it as the way you should, right? But then it'd be more helpful to sort of more generally speaking, not just when you have a layoff and then you just buy your house, but more broadly speaking, what are the wage effects? What are the effects of these things, even if you didn't just close on your house? Okay. But in closing, I think this is an incredibly ambitious project on important work. I think the role of LTV caps, as we probably all agree in this world, in this room, is going to be super important to understand, and these sort of effects are going to be really important to understand for policymakers. So thank you so much.
Great. Well done. Thank you. It's 10 rows back. Kasper and Gazi as well, if you want to come up, I mean, you could just respond very quickly, and then we'll see if we have time for one or two questions.
Yeah. Thanks a lot, Asaf, for your thoughtful comments, and I'd love to talk a little bit more later on. And let me go a little bit brief on some of your comments, but I think some of them are just really good suggestions and things that we can do, and others maybe we have a bit of a view on. So, on this question about the selection effect into the housing market, for example, I think this very, why don't we see, for example, stronger effects? So one thing I think is really important here is that fiscal incentives to buy houses are just extremely strong. So home ownership is somewhere between 80 and 90% in Norway. So deciding to go into the rental market is like that's a big step. You forgo a big fiscal benefit, and you may actually end up having access to a very different pool of houses. So I think that's an important, maybe sort of circumstantial condition that we may want to spend a little bit more time on sort of clarifying. Yeah, and then there's the question about, how do people fund this 100,000? So we don't have a perfect answer to that. One thing that is particular for Norway is that there is no credit register. At least there was no credit register. So the policy applied to mortgage credit, but in theory, it would be possible for people to take an unsecured loan at the same time and fund the purchase of the down payment with the unsecured loan and then pay it off, for example, in the years to come. But since there is no credit register, that's hard for us to observe. Then on your point and what I just wanted to say was that your comment maybe did make us think about one thing, is that we could actually look with some new data that we have at the consumption patterns of these households. So we've gotten access to credit card payment data. So we might be able to match that and see if people, who are affected by this policy actually change their consumption pattern and sort of stock up cash in that way, or sort of deposits. Then I think the other comments are just very good suggestions. We should think more about these distributional effects and the external validity. Somebody else made a suggestion and said, why do you just look at, at people who are sort of lose their job in mass layoffs? There's a much larger group of people, so it would be nicer to look at those people because it, gives you a better sense of how it would work in the economy as a whole. On the other hand, I think, one might argue that, it's nice with clean identification, and, typically we, when we think about sort of big economic recessions, then people, have a much higher likelihood of being laid off in these kind of big layoff events. But thanks a lot, and I'd like to discuss that more afterwards.
Thanks. So we're short on time. If there's any questions, you take one. Renal, yeah.
Yeah, I'm just thinking about
Can you use your mic?
Just thinking about alternative policies that might kind of get at this, like I know Norway has pretty generous unemployment insurance, but maybe it's not generous enough. Like, would that kind of, because you didn't kind of study this so much, but there are costs to this kind of policy, right? But so do you have any insight or any way to kind of think about how this policy might compare to something like that?
Sorry, I'm not sure that I understand.
I'm thinking about
unemployment.
No, we could.
Insurance?
I mean, another way to get people to search for longer is to make unemployment insurance more generous and make it last longer, right? So, I guess maybe this is not really a fair question, but why is this the policy that would be, preferred over something like that?
Right. So I guess, an important question I don't really have the answer to that is, of course, do we believe that, that leverage is really important for how people behave? Or do we believe that, for example, liquidity during relatively short spells of unemployment are the driving factors? And,
right.
There's research out there that suggests that liquidity is really important. And I guess our results kind of suggest that, maybe the mechanism is slightly different. It's actually sort of coming from this permanent concern that if you have a lot of debt on your back, that affects your behavior. And so it's not, if you believe that such a mechanism is more important than maybe providing sort of short-term liquidity, as, for example, Kyle Herkenhoff is one of his papers, is maybe not the solution to the problem. But, it's a hard counterfactual, so to say.
Great. Thanks so much, Kasper. We're at the end. While I have you here, I just want to say a couple of quick things in conclusion. So the first one is, I just kind of want to echo or reiterate the comments of Bob Hunt from this morning that, we, on behalf of the organizing committee, we express our profound thanks to the conference team here who kind of made this thing, stand this thing up and really make it a successful conference. So particularly I'd mention Nicole Rizzo, and Josh Rivera and Kristen Santiago are all here in the room, but there's a bunch of other people as well. So could you just put your hands together for them? And I also would thank Bob Hunt and the CFI and also the research department and the supervision department here for their support. And then finally, thanks to all of you. It's a lot of great discussions. It was great. It's my first in-person conference for 2 years, and so it's great to see everyone in the room. And thanks to all the people that joined online as well. And I would just sort of mention, this is the first time this is like the first sort of inaugural version of this conference, and hopefully it will turn into a regular event.